The second main division of a merchandise income statement is the cost of goods sold. Now, just as the title says, this is a determination of the cost of the goods that we sold. So these are the costs to the seller of the goods sold to the customer. Now, all merchandise companies have goods on hand, and they are to be sold to the customers. So goods that are on hand for sale to customers is called merchandise inventory. Now, the cost of goods sold then is determined by computing the cost of the beginning inventory of merchandise, plus the net cost of all the goods we purchased to be resold, and finally, the ending inventory. Now, when it comes to inventory, there are two methods. There's called the perpetual inventory system and the periodic inventory system. Now, under the perpetual inventory system, the merchandise inventory account is continuously updated to reflect items on hand. For example, when you go to your supermarket, you see that they ring things through on a scanner. That way, they can adjust their inventory account with every sale. Under the periodic inventory system, though, the merchandise inventory account is updated periodically after we take a physical count. Usually that physical count is taken just prior to us making financial statements. So therefore, companies who use periodic inventory procedures make no entries in the merchandise inventory account. To determine the cost of goods sold, they know what their beginning inventory is because they counted it at the end of last year. They use accounts called purchases, and they debit the purchases for merchandise inventory that they purchase, and then they take an ending inventory at the end of the accounting period to determine how much of the items that they purchased in the inventory have been left unsold. So on an income statement, the company would show that information in the following fashion. First of all, the beginning inventory. That is the inventory at the beginning of the accounting period, which was the ending inventory of the last accounting period. To that, then, they add the net cost, and we'll talk about net cost later, of purchases during the period. So I started off with $34,000. I purchased $140,000. Therefore, I have $174,000 available to be sold to my customers. And I sell throughout the whole year. And at the end of the year, I then count what is left unsold, and therefore I determine my cost of goods sold to be that difference. In this section now, we're going to look at how we record purchases, purchase returns and allowances, and purchase discounts. We begin with purchases under the periodic system. Assume as handling retail we made two purchases. One, $30,000 on credit. We bought from Smith Wholesale Company on May 4th. And on the 21st, we purchased $20,000 for cash. Well, the May 4th purchase, debit purchases. Now, purchases are assets. We're debiting inventory. So it's a debit balance account. Credit, accounts payable, I am going to owe them. On May 31st, I purchased $20,000 for cash. So, purchases is an asset account, therefore it has a debit balance, and the transactions are fairly straightforward. Now recall when we made sales, we offered credit terms to our customers. Well, when we purchase from our wholesaler is selling to us on credit terms. And so therefore, let's assume that May 4th purchase said $210 net 30. Which means if I pay before May 14th, I can take a 2% discount. But I must pay the full amount net 30. So, if I pay by the 14th, then I cancel my accounts payable. So I debit accounts payable. I no longer owe him $30,000. I didn't pay him $30,000. I paid him cash of $29,400, and I took a discount. So that's how I record during the discount period. Now, again, this is a new account, sales discount. It has a credit balance. It is a contra account, Just like we had contra revenue, this is a contra account to purchases. Purchases has a debit balance. Purchase, debit balance, purchase returns or purchase discounts. Okay, a credit balance. So it will be subtracted from the purchases. Now, by the same token that we had sales returns and allowances, I am the buyer here. And if I want to return these items because I find they're defective or not what I ordered, then I use an account called purchase returns and allowances. Now, sometimes I may return the item. Other times the item may be a little defective. I want to keep it, but I want an allowance. So I use the same account for that. So let's assume that Hanlon returned $350 of merchandise to Smith. Well, I reduce what I owe. And again, purchase returns and allowance is this contra account to purchases. Now we have to talk about transportation, because transportation, when I pay the transportation to bring items to my business that I'm going to resell, then those transportation costs are part of the costs of inventory. Now it depends. If I have an invoice from my supplier that says that the goods that I am being sold are free on board, shipping point, that means myself, the buyer, incurs the transportation costs after the merchandise has been loaded on my containers. So therefore, I must add the transportation costs to the cost of those items I purchased. If, on the other hand, my invoice says FOB destination, that means the seller will pay for the transportation of those goods to my back door. But he's not doing that for nothing. He's built that into the cost of the items he sold. So if it's free on board shipping, then I have to have an additional account called transportation in which I record the freight costs that I incurred for acquiring merchandise. Now, this transportation in is an additional account that is added to the net purchase to arrive at the net costs of purchases. So now, to put it all together, the second section of the income statement for a merchandise company is the cost of goods sold section. And if we're on a periodic inventory system, as we've been discussing, then this is how we would put it together. We begin with the merchandise inventory, the beginning of 2010, which is the ending inventory of 29. To that, we add all the purchases, gross purchases we made during the year. We debited the purchase account for $167,000. Now, if customers took, or when we took discounts, we credited a purchase discount account. And when we returned items, we credited a purchase returns and allowance account. So you see, this $11,000 is deducted from purchases to get the net purchases. Now, in addition, we had to pay transportation costs. So that was $10,000. And we add that to come up with a net cost of purchases. So I had $24,000. The net cost of all the purchases, including transportation and returns and allowances and all of that, is $166,000. Therefore, I have $190,000 available for sale. I subtract. I take a physical count. December 31st, 2010, I count what's left unsold, and therefore I come up with a cost of goods sold of $159,000. So that completes the second major part of a merchandise inventory, a merchandise income statement. We're now going to look at what's called the classified income statement for a merchandise company.